Big tech earnings have prompted my thinking about why market thinks big tech is recession-proof. Don't skip it. You know when I get in the zone. Fun fact floating on FinTwit. It took 14 years for the S&P to gain 30% from 1966 to 1980. It has taken just over 14 weeks to climb 30% since April this year. Actually, NDX is up 45% off the lows, and SPX is up 33%, and we know why. Nvidia, Microsoft, Meta each doubled off the April bottom after July 9th policy intervention by Trump. We also know that the market remains heavily bifurcated. The top 10 stocks now account for 40% of the S&P, a concentration level not seen since 1932. And after reporting earnings helped, as the monsters of tech grew much larger, Meta plus 10% in after hours, adding $174 billion in market cap. Microsoft plus 6.2% in after hours, adding $220 billion in market cap. That's $394 billion in total market cap added in seconds in just two companies. That's akin to a new Johnson & Johnson-sized company created out of thin air, which happens to be the 22nd most valuable company. Or impressive that Microsoft and Meta together went up after hours more than the entire market cap of the largest company in Europe, SAP, at $350 billion. The market bulls keep shouting, it's all about the capex, and hyperscalers' capex as percentage of operating cash flow is expected to remain high for the foreseeable future. The company projected capital expenditures will jump to more than $30 billion in the September quarter, up from $24 billion in the June quarter, and implying Microsoft could spend $120 billion for the full fiscal year ending June of 2026. That represents an astounding increase from just a few years ago. Microsoft spent $29 billion in all of fiscal 2022 on capex. And Meta has projected its capex will jump to as high as $72 billion in 2025, compared with $39 billion last year. Today, the company said it expects 2026 capex to rise by similarly significant capex dollar growth, implying it could pass $100 billion next year. How big is that capex spend anyway? Meta, Microsoft, and Alphabet have spent $186 billion on capital expenditures over the past year, more than the revenue of 96% of S&P 500 companies. The naysayers be damned. Meta's free cash flow fell 52% year over year. Microsoft shows receivables rose faster than revenue, suggesting pulled forward revenue. Famed short seller Jim Chanos can't even nudge Meta from its gap up. It looks like Meta's depreciable life on its capital base, $210 billion at June 30th, 2025, was 11 to 12 years as of the second quarter. If the true economic life on its GPUs is actually 2 to 3 years, most of its profits are materially overstated. Forget the tricks around securitization and financialization. The big tech consortium has also pulled off the ideal closed circuit system, the magic circle of cloud credits, GPUs, and growth, money from one pocket to another. Marko Kolanovic, ex-JPM chief strategist, said, data centers may end up being the biggest misallocation of capital in human history, bigger even than windmills. Trillions to tweak order of videos and reels, or spy on you to better target ads. All these negative voices are ignored because valuations don't matter during a paradigm shift when big tech is recession-proof. There is no way to explain current S&P 500 levels without using at least a peak confidence PE ratio of 22x and applying current consensus earnings estimates or super peak PEs of 24x and a small 10% haircut to 2026 earnings. The last time the S&P 500 traded for 22x was in 2021, when massive fiscal and monetary policy stimulus assured the U.S. would not go into a recession in the next 12 months. The last time the S&P traded for 24 times earnings was at the peak of the late 1990s dot-com bubble. To believe the S&P has any upside from here, one must be confident that multiples can either hold super peak levels and index earnings will be at least $302 per share, or that we can see fresh highs for PE multiples, 26x, and future earnings are all but assured to grow by 3 to 14%. And Meta and Microsoft are there. Subscribe, like, share for more deep macro, fundamental, and technical analysis research from LaDuc Trading. For actionable trade setups that support this research, join us live at www.laductrading.com.